Good morning, everyone. Yesterday's U.S. trade figure showed some narrowing in the trade deficit as exports rebounded, but imports also rose, which will depress the already low first quarter GDP figure. That weighed on the dollar, and the U.S. currency made new lows for the year against sterling, the Norwegian krone, and the New Zealand dollar. We could see further new 2014 lows against other currencies, too, depending on what Fed Chair Janet Yellen says in her testimony tonight to the Joint Economic Committee, particularly if she sows some doubts about whether the Fed will end its quantitative easing program on schedule later this year, or if she tries to push back the market's expectations of when tightening will begin. Personally, I expect her to remain fairly cautious about when rates might start going up. While the unemployment rate is now below the Fed's threshold of 6.5%, she's emphasized other measures of tightness in the labor market, such as wage growth, which admittedly does remain rather slow. I do not expect her to repeat her previous explanation that the phrase considerable period of time between ending quantitative easing and raising rates means 6 months. Sterling was supported overnight by a story in the Financial Times saying that, quote, with unemployment now below the Bank of England's 7% threshold, the bank is no longer bound by its guidance last August to keep interest rates at a historic low of 0.5%. Monetary Policy Committee members predict greater dissent among their ranks. While no change is likely at tomorrow's meeting, the article noted that the Bank of England's quarterly forecast and inflation report next week are likely to signal a further shift towards earlier rate rises. Yesterday, the market failed just 4 pips short of 170 in cable. Another attempt looks increasingly likely and, in my view, likely to succeed. The weakest currency overnight was the New Zealand dollar, which has been rising and rising recently. The reversal came after RBNZ Governor Wheeler said the rising currency could become a factor in their consideration when setting interest rates, and in particular that the continued strength of the currency despite weakening prices for exports might justify FX market intervention. The comment came on the same day as the price of New Zealand whole milk powder fell for the 6th straight auction. Also, New Zealand unemployment was a bit higher than expected in the first quarter, which weakened the currency a bit. Nonetheless, I still believe that the market has it in mind to keep buying the Kiwi as the country's budget shifts into surplus, which is a rare condition in the G10. So I expect the Kiwi rally to resume after a period of consolidation. For today, the main indicator out during European time, German factory orders, is already out, so I expect a relatively quiet day while we wait to hear Ms. Yellen. For more information, including technical analysis, please read the full comment on IronFX.com. You can also follow us on Twitter, like us on Facebook, subscribe to our YouTube channel, or circle us on Google Plus to get more trading ideas. This is Marshall Giller, Global Head of FX Strategy at IronFX Global, wishing you solid trading.